High interest rates f***ing suck. So today we're going to be talking about one of the biggest items in real estate today, and that is interest rates and how it's hurting home buyers across the board. I'm here with David Fields, and we're going to be talking about potential tactics for buyers in overcoming these high interest rates that they're facing today. David, I guess, how are these interest rates, let's kick it off, how are these interest rates affecting your clients today?
Yeah, I mean, it's definitely an interesting time. We've kind of found ourselves in this market that is like a high interest rate and a low inventory environment. So it can be tough. It definitely affects affordability. You know, monthly payments go up as interest rates go up. So yeah, the clients are feeling it. I think affordability is a little bit down, and when the market's tight, it just makes things a little bit tougher.
100%. And also, if you bought a house 10 years ago and you got a 2.75% interest rate, you're gonna wanna hold on to that, because if you go back to the market today, you're gonna be looking at 6.5%, maybe even higher than 7%. We're here to talk about what buyers can do to potentially lower that blow and lessen that interest rate. And the first item being an assumable mortgage, which not too many people talk about. It's kind of becoming its own asset class in today's environment, because when an owner has a 2.5% interest rate on a house, that is very attractive to a potential next buyer. I guess one of the biggest things with an assumable mortgage is when you're buying a house and you go through the pre-approval process and you talk with your lender and he says, hey, it's gonna be a 6.25%. And then you go work with a real estate agent, you start seeing homes, you find a house you fall in love with. What's the first thing you should do?
The first thing you should do is obviously ask the agent on the other side if they have any sort of advantages. Like if they're in, let's just say, an FHA loan where they have one of those low interest rates that got locked in, can we assume that loan? I think it's a really great question to ask. And I think it's something that up until recently, like, you don't hear it advertised, right? Like you don't hear an agent saying, oh, we have a $300,000 assumable loan on the property. But I think now that people are starting to kind of get creative and come up with ways to avoid these super high interest rates, or fairly high interest rates, I think we'll start seeing it advertised more as well, which is helpful.
100%, and I think it's very important. The first question you want to ask a seller or a listing agent is, hey, does your seller have an assumable loan? Unfortunately, there are some constraints with assumable loans. Assumable loans are only government-backed loans. So those are FHA loans, VA loans, or US Department of Agriculture loans.
Right.
So unfortunately, if your seller got a conventional jumbo loan, it's likely not assumable.
Right.
But it's always worth asking the question.
Right.
It's not gonna hamper your chances at getting the house, and you never know. The seller might have a FHA loan that's got a $300,000 principal balance, and you're trying to buy it for $350,000, which in that case, you would just have to come up with the difference. But there are some cons, obviously. So if you go to a seller, what could a potential con be if they have an assumable loan?
Yeah, I think you just kind of mentioned it. So one of the things that you definitely have to think about is that whoever's buying that property is gonna have to come up with the funds for the difference of what they're buying it for and what's left on the mortgage. So like in that example, you said, okay, they have $300,000 principal balance, they're buying it for $350,000, they're gonna have to come up with that $50K. So if you don't have the cash on hand, it can be tough. I mean, I'm sure that there's ways around that. You can get a loan for the difference, or maybe gift funds, things like that. Figure out a way to come up with those funds.
Yeah.
But it's something to keep in mind.
Absolutely. So like, for example, if you're buying a $800,000 house and the seller has a $300,000 assumable loan, then essentially you have to figure out a way to come up with that $500,000 difference. And that could make a buyer a little uneasy, because it's a lot of cash to come up with. And there are creative ways to bridge that gap though. You could potentially go to your current lender and say, hey, I can assume $300,000. Can you give me a second loan to bridge that gap? It involves some additional paperwork than you'd be normally accustomed to. But when you look at the numbers versus getting just a 80-90% loan at 7%, it could end up being beneficial economically. So,
I mean, a 4.5% delta is huge.
It's huge.
It's definitely worth looking into.
Yeah. So highly recommend buyers, first question, ask the seller if they have an assumable loan. If not, okay, we'll go through the traditional loan process and potentially refinance down the road.
Yeah.
What are some other creative ideas or tactics that you've seen buyers come up with recently?
Yeah, I think one of the big ones that we've kind of seen a lot since interest rates have ticked up a little bit is just doing your buy downs. Like there was the 2-1 buy down, which we've kind of explained in other videos. You can just like pay for points so that you can get points off your interest rate. And then I think another interesting thing to at least look into when you're on your house hunt, is seller financing.
Yeah.
You probably know more about it than I do, but
I wouldn't say that much, but I mean, seller financing is also a really creative ways for buyers to potentially get a much lower interest rate, because if you find a seller who's got 100% equity in their property and they don't technically need the cash right away, then you can approach them and say, hey, I see that you don't have a loan balance. Would you be interested in discussing potential terms on seller financing, where you essentially say you'll put up 75% of the equity to buy, I'll bring in 25%. We'll figure out an interest rate that works for you. In this environment, you might be able to get 5% versus you go to a traditional lender and they're offering 6.5%, 7.5%. So that is another creative way for buyers to salvage this interest rate environment as well. So another interesting tactic for home buyers in this high interest rate environment is what's called an interest-only loan. And you're typically gonna find these with your top 5 large institutional lending companies such as JP Morgan, Bank of America, where essentially you're required to park a certain amount of cash in a checking account, let's call it Bank of America. It's usually quite a large sum, let's call it $200,000. You form that relationship with this large institutional lender. Typically in those instances, they're able to offer you a really advantageous interest rate because you've shown that you have the cash, you've put in their institution. And in those cases, I've seen a lot of buyers get some really interesting financing terms, one being the interest only, where essentially it's not amortizing where you're paying down principal each month. It's just an interest only payment across the term of the loan. But what's great about that is, let's say you have an interest only loan, end of the year, you get a $50,000 bonus. You could just pay that into your principal and start paying down your principal as the time goes on. You're still paying your interest amount, and then you're building more equity. And those interest rates end up being a considerable amount less than what you would see going to a traditional mortgage lender.
Conventional finance. And your monthly payment will be a lot lower.
Yeah, exactly.
So it's like, so let's say you do that for X amount of years, rates adjust a little bit, maybe they come down. Then at that point, maybe you think about refinancing into conventional financing where you're not paying 6 3/4 or 7 1/4, maybe you're paying 5.
Exactly.
High 4s, low 5s, something like that.
And it's great for people that are looking at a potential purchase and they're looking at their bottom line. Here's what my monthly principal and interest is going to be. And then you look at the interest only product and you're like, it's quite a bit less. And I can slowly start paying down principal as time goes on. Life changes, job changes occur. So I think that that's definitely worth exploring. Obviously, it depends on your financial situation and how you look at taking on debt and whatnot. So those are 3 good ways to approach a new purchase that I think everyone should think about, explore when they're looking at a house, see if loan's assumable, see if the seller is open to seller financing. If the loan's assumable, you might even be able to get seller financing to bridge the gap. That's a great way. And then potentially going to a large institution and getting interest-only loan.
I was gonna say, actually, we'll see like how this fits in. But one thing that I've seen a few of my clients doing is going to like a local credit union where they can have an established relationship. Usually they're kind of willing to give discounts on rates, or if they have like a really good established relationship with a bigger bank. If you're like a private client, something like that, usually you can kind of pull some strings and get better deals.
Absolutely, and everything's always negotiable. Like when you are talking with a lender. There's stuff that isn't negotiable, but there's stuff that are definitely negotiable.
Yeah.
And that's where we come in, and you always want to consult your real estate agent and say, here's my lending breakdown. What do you think we can negotiate on? What do you think we can eliminate? What do you think we can decrease? So those are fungible. And I think it's wise for everyone, instead of just taking what their lender says at face value, to always consider trying to negotiate. Because at the end of the day, the lender wants to keep you as a client. Yeah, like you said, these large institutions like Chase and Bank of America, if you're a private client, if you have a long-standing relationship with them, they want to keep you as a client, and so they're going to do everything they can to get you the best possible financing terms.
Yeah,
So,
absolutely.
Yeah.